Hello and welcome everyone, wherever you may be tuning in across this wonderful region of ours. My name is Elio D'Amato, but today I'm hosting the Investing Mastermind series, of which the latest edition is this great man just down below me. It's Alan Hull from Act Invest. How you going, Alan?
Good, very well, thank you. Thanks for having me on.
No, thanks very much for joining us and for sharing your insights in regards to a plethora of investing. And I'm going to ask a little bit about your background in a moment, but just to show you how old I am, folks, I can remember when I started this investing journey all that time way back. And this man right here, Alan Hull, was one of the stalwarts of vocabulary who you basically needed to listen to and really understand in order to understand what moved and drove markets. Of course, my path or our paths sort of dissected a little bit along the way, but I suppose they come together nicely in this little presentation today. So, Alan, in advance of anyone that's got to go before time, thank you very much for joining us today and for sharing your vision.
Thank you.
Okay, so just quickly, folks, just before we get into the juicy stuff, a reminder, as you know, that all this information is of a general nature only. None of it is intended to be taken as financial advice in any way. And should you wish to discuss any of this content with anyone other than your significant other in life, then you need to do so with a licensed advisor who can have that conversation with you. That's not us. Okay, and we'll get to the offers in a moment, and I suppose what is really the heart of what we have as the Invest My Way. I didn't mention that Alan Hull is an acclaimed author, but Alan, rather than have me talk, because I've given a pretty long-winded introduction at the moment, let's go to you. Tell us a bit about your background. How you know, mate, we're all rock stars. We all sit on top of the ivory tower, but not many hear about our stories, our journeys to get to this point. And often that can teach you a little bit more about the process rather than necessarily the output itself. So, take it away, Alan. Tell us a bit about yourself.
No worries. Okay, Elio. So it's actually, I think it's in the preface of the book, Invest My Way, just quietly, my background. So I'm at the ripe old age of 62. So when I was 8 years old, so that's 1970. My father, who was in the share market, he was a trader before me. I'm a second generation trader. He was trading around the Poseidon boom. No. So he owned shares in a stake called Western Nickel, which had a stake next to Poseidon, and the shares he bought went from 10 cents to $20. And I was sort of aware as a child about this. This is pretty cool, making money without working. And he said, for my 8th birthday, I'll buy you a share. And I said, cool. So we got the Sun newspaper in those days, went through the share listing, and he said, pick a stock. And I just basically randomly picked a stock. Now, I'm sure he didn't go and buy it, but it cost about $5. And he sort of said, yeah, okay, you've got the share. And 6 months later, it doubled. And I sold it. And so I turned this $5 into $10, which I paid me the cash for. And I thought, this is huge. And he said, well, you want to buy another share? And I said, yeah, sure. I said, but this time, can you pick it? And he said, yeah, okay, I'll pick a stock for you. This is doing very well. So he picked the stock. Now, the stock that he picked halved in value. So in the next 6 months, it halved. And I said to Dad, I said, you owe me $10. He said, no, I don't. You asked me for my advice, and I picked that stock, and I gave you that advice in good faith. So if you want to pick your own stocks, then you need to learn about the stock market, don't you? And I took him at his word, and that's basically how I ended up here. So that's the history. So I go right back to the owned my first share at the age of 8. Over the journey, so and I've been involved in the share market for literally decades of using fundamental analysis, using technical analysis, listening to rumors, following the gurus in the market, the guys like Kerry Packer, follow them around, try to do all that sort of stuff. I've literally done everything. So it's been a case of trial and error. I always say that the people who are truly successful in the market are the ones that don't necessarily know how to make money. Well, they do, but they know how to lose money because they've done it. It's what we pay our college fees with what we learn. What all of those decades of doing many, many different things in the stock market basically has culminated in is the awareness that you need to be across everything. So when I say that, no need to be scared. What I'm talking about is it's a toolbox approach. There is no holy grail. There is no particular fundamental ratio. There is no particular technical indicator. There's no particular news feed. There is no particular guru you can follow that is going to be the solution. So we have a toolbox of all sorts of stuff that includes technical analysis. It includes fundamentals. It includes news and keeping your ear to the ground, having knowledge of the share market, having knowledge of the economics, having knowledge of the monetary system, having knowledge of global politics. It's all of those things put together. The market is a dynamic creature. What it is today is not what it was 10 years ago, and it certainly isn't what it was 30 years before that.
And I think that's a really good point. Just quickly, Alan, but many people turn to technical analysis because they're looking for the silver bullet. And you talked about your toolbox approach there, and that might dishearten a few because ultimately they just want to take the pill. Yeah, sure, they want to lose 30 kilos, but they don't want to do the work in order to get there. How do you educate and inform members who are basically looking for that silver bullet, that are looking for that?
You have to dispel it. I mean, you have to dispel it fairly quickly. Why I guess my mainstay, if you like, is technical analysis, is because technical analysis is basically the study of price information over time. So it's a two-dimensional, it's price versus time. It is the truth. It is the facts. It is the reality of the market. It tells us really what the investors are doing, what they're thinking, whether the price is basically going up and down over time. You know, the news can be fake. You know that the fundamental information that is being released by the companies can be fake. It can be wrong. I cite a simple example of HIH. So, all that situation, when we're looking at price information, it is the absolute truth and the reality. So you can have a situation, for instance, where we're in a fundamentally underpinned market. If you go back to the 1990s, that was a fundamentally underpinned market. So people were very aware of fundamentals, and they were looking and understanding and analyzing fundamentals. And we were just really starting. It was the early days of technical analysis. And it was those fundamentals that was driving the market. If you had a conversation about a share, a company, you'd be talking about debt to equity ratio. You'd be talking price to earnings ratio. You'd be talking asset backing, all that sort of stuff. If you take the early millennium boom, so post 2000, when China was all the rage, the stock that was at the top of our hit list was Fortescue. Now, Fortescue didn't have very good fundamentals. It had terrible fundamentals at the time, but it was a sentiment-driven market. So it was more about who had the best, publicity department as opposed to who had the best fundamentals. And people weren't talking about debt to equity ratio and asset backing, et cetera, et cetera. They were simply talking about how much money they'd made on their Fortescue shares. So that's a sentiment-driven market, and you need to really come at that principally through technical analysis. So that's principally a technical analysis market. If you go back to the 90s, when you're in a fundamentally driven market, it was very linear. When we see price action that moving in a straight line, we know it's linear, and we know it's essentially fundamentally underpinned. And that's where you need to pay close attention to the fundamentals. And it depends whether you are a growth investor or if you are an income investor. If you're buying a stock for income, then you're buying into the profitability of that company. So fundamental analysis is absolutely at the forefront. And we're going to look at some. I'm going to show you some charts of some income stocks and show you what we need to look for. It's very simple. When you're in investing for growth, then you need to be looking very closely at the price action, because that's what you're investing in. You want to buy a share at a price, sell it at a higher price. Obviously, your principal concern is that price activity. If we're looking at growth over the longer term, fundamentals plays a huge role. If I'm looking at buying and selling a share over a 1 month time frame, all I need to look at is the technicals. Fundamentals are not going to play a significant role in that time frame. But then we have the issue of news. So news can play a very big role in a very short space of time. What was the one you mentioned before? CrowdStrike. What happened to them on Friday? So simply that one little disaster, their share price has been absolutely decimated. So she thought stock price, it's American listed. So, it's been decimated. So that's news. We have the situation, the political shifting sands in America. And we have that situation now where Biden's out of the running. And that's a bit of a boon to the stock market because the US stock market does a lot better under Republican. So the fact that they're really now looking like they're going to win the election, the presidential election with Trump, that's a good thing for the stock market. So we've got to be across all of that stuff. But at the end of the day, the sharp end of the stick, technical analysis. And in second place to that, I say is fundamental analysis.
But I mean, look, like you alluded to, the price doesn't lie. I mean, effectively, it moves as it does, and it does that, and eventually either the news catches up one way or the price catches up. One of the two will occur. But you were kind enough to share a training and education session with our members, Alan, via a series of articles that you'd done. And you talked a lot about the basics of technical analysis, and possibly to those that were well indoctrinated in the topic, they were comfortable with some of that content. But then there were others possibly being introduced where that might have been a bit over the top. So condensing it all into one response, what do you really think is a key area of focus that us mug punters need to be focusing our attention on when it comes to using those squiggly lines?
Okay, basically, when most people come into the world of charting, there's so much information. I mean, when I started out, there was very little information. Now there's a huge amount of information. And I say that the biggest problem is actually just thinning out that information because you just get totally confused. And I'm sympathetic towards people today. What happens is you normally jump into it and you think the more complex, the more involved, the more scientific, the better it's going to be, the better it's going to work. So the more I know and the harder I study at technical analysis, the better I'm going to do as an investor, as a trader. That is simply not true. Yeah. So what it is you usually find people delve into technical analysis, get into all the rocket science, and then they end up backing up. And they say, hang on, I'm just totally confused. They have charts that look like Christmas trees. We describe them as a Christmas tree. And you need to take all that stuff off. The first thing I do as a chartist I've been doing it for a very long time, is just look at the raw price data. And we're going to do that with some charts today. Yeah, so the basic question you start with is up, down, or sideways. That's it. I mean, the market has three speeds, up, down, or sideways. True. Where it gets complicated is working out and determining your perspective. And that's about you. So what we've got to do is, that toolbox that I supplied was basically, it's basic. It's a beginner's toolbox. So it gives some very simple explanations of pattern recognition. It gives an introduction to moving averages, which is probably the basic technical tool indicator we use. And then it develops into some of the techniques like the countback line, Dow theory stop loss. And we start to look at the applications rather than understanding how these things are made. It's like holding up a hammer and going, it's made of wood, it's got a metal shaft, whatever, it's weighted this way, da-da-da-da-da. Then you go and talk about applying it and actually hammering in a nail. And so those later modules talk about the Dow theory, but they say this is how we use it. So we use it as a stop loss technique. We use it to determine if a share is trending up or down. Okay, or sideways. So they're just the basic tools. We use those today. I do a show every week called Alan Hull TV. I do it on Monday. I look at my stocks. I look at your stocks that you submit. And we use Dow theory stop loss. We use the countback line. Occasionally I use moving averages. We still use those very, very basic, simple tools. And they work extremely well. Everything else that you see in technical analysis, when we start talking momentum indicators, oscillators, stochastic, RSI, MACD indicator, it's just all derivatives of the basic set of tools. And I would say to people, you should never, ever put an indicator on a chart if you can actually look at the raw price data and see what's going on. In other words, we only use an indicator when we can't actually see with a naked eye what is going on. Let me give you an example. There's a thing called the rate of return indicator, which I use in all my newsletters, and it simply tells me how fast a share is rising. So I see a price pattern and I see the price going up like this. How fast is it going up? Is it going up 10% per annum, 20% per annum, 30% per annum? I can't tell with the naked eye. All I can tell is it's going up. So I have to measure that trend. So therefore, I use an indicator. So I only reach for an indicator when I can't see it with the naked eye. And it's needs driven. It's needs driven. And I say that to people. It's very important to understand that if you don't work on the basis that you use technical analysis on a needs driven basis, then you're going to end up with charts that look like Christmas trees laying on their sides. Because it's just you get tied up in knots.
Yeah, look, it's interesting. I mean, I've got a picture there of the book, and of course, members, I'm just about to call up the should be able there we go. That should work in a moment. So on the right hand side, if you click on that little trolley there, you'll see a link to Alan's bookstore where you can purchase his book. And I've sort of called up Invest My Way. You've got a few books there, Alan, obviously, in regards to different ways and the like that you traded.
There's a red book there.
Yeah.
Now, I could speak to Invest My Way. I'll speak to the red book that's active investing. Now, just for instance, it's 50,000 words. It's over 100 charts, and it contains 3 indicators.
Right.
3 indicators. That's all it's got in it. Range indicator, rate of return indicator, multiple moving average. So that entire strategy is just 3 indicators. So it's not about complexity, and that's the thing I can't stress enough. It's about understanding what it is you're trying to achieve, what is your perspective, what is your time frame, and then we go from there. So the first question people ask me, the first question I will ask you, if you say, what do you think of Aristocrat, or what do you think of Telstra, whatever, I will say, do you own it for income or do you own it for growth? Because if you own it for growth, it should be trending up or going to trend up. If you own it for income, not really that important. Price activity can be sideways and it can be sideways for years. Doesn't matter. If you own it for income and you're getting a nice big dividend off it, and it's got, profit growth over time, et cetera, well, it's fine. So you've got to know where you're coming from in this whole thing. Otherwise, you'll just end up with, like I say, in a mess, in a tangle. And we come across that a lot. What I try to do is provide clarity. I always say my job. We're an IP provider. We're an information company. We're an IP provider. And my job, as I see it, a key role of it, key part of it, is just constantly providing clarity. I can give you a for instance. So recently, literally in the last couple of weeks, we've seen the markets. Last week, we saw the US markets drop and the Australian market, whether you like it or not, they sneeze, we catch cold, and it dropped. Basically, a lot of people, it was quite a hefty drop at one point. I think the NASDAQ came off 3% in a day. Technically, it's hit a major overhead resistance level. And that drop was absolutely expected, absolutely normal, absolutely expected. We were due for a pullback. Markets go up in a sort of sawtooth pattern. It hit the roof. It literally hit the roof, and it's come down. It's buy on the weakness. So it's not nothing to be scared about, and that's where I provide that kind of clarity. Because people don't know. Without a roadmap, you don't know. You're just looking and going, oh, wow, these markets are dropping rather sharply. This is a bit concerning. And you don't really know. So that's where, technical analysis gives you that roadmap. It gives you that framework. And I think that's very important.
And that's why, that blue book, so not the red one now. So this is a little bit of an easier read, just a tad bit.
Yeah.
But I can remember when Alan gave it to me, actually, when he first wrote it. And I can attest to the fact that it is a bit of a strategy map to further assist on top of one we send you. Trust me, shortage of education is not what you ever going to criticize Alan or myself for, that's for sure. But $29.95 is all it costs. And if you're a member of Stockopedia, it's really not that far a stretch. So you can access that link there and have a look. And we've also got a little offer for guests in a moment, and I'll come to that in a tick. But I do want to start talking some stocks, because one of the great things with technical analysis is that I can actually pull them up on screen and we can talk to them, and you can educate us through showing rather than necessarily worrying about the boring fundamentals, as it were, which as you know, I have an impartial bias for. But nonetheless, a couple stocks, but I want to start with one of them in particular. Now, bear with me as whoops, Daisy, didn't want to do that. I want to go to right here. So hopefully this is now appearing. Okay. One of the stocks I want to talk about is 360. It's a stock I've held for quite a while, so I'll just disclose that to everyone. But, geez, if they all looked like this, it'd be happy days as far as I'm concerned, because it's got a wonderful-looking chart. Now, bear with me a moment, Alan. But you wanted to talk to this because you reckon there's some good lessons and learnings
there are some good lessons. Okay, so we come down to, again, first fork in the road. And this is actually, just to clarify, by the way, the Red Book, Active Investing, was the first book. It was a bestseller. But you're right, it's fairly technical. And I actually took a step back from it, and that's where the Blue Book came from, Invest My Way, when I was a lot more, okay, people don't know this. We need to go back, and we need to sort of build that stronger foundation. And that's why I always recommend the Blue Book, even though it was written second. It's really the first book, and that's why it's been recommended to the audience. So basically, Life 360 is actually based in San Francisco. It's listed on the Australian market. It is one of our very, very, very few AI stocks. And so it uses AI, very much a tech stock. And so it's trending up. Now, what's driving the market at the moment? This is a very important lesson. So we go back to the 1990s. It was all about fundamentals. We'd gone through the 87 crash. So all the speculators had left the market, and what was driving the market was the fundamentalists. It was the fundamentally motivated longer-term investors. So it was all about fundamentals. And it's very important to be aware of what I call what phase the market is in. And I teach this in my course. So what phase are we in? Right now, in America, you have three key themes. And it's very, very important, if you can identify the key themes, that you just go with those, all right? One of them, you've got an incumbent president, well, not quite anymore, but you've basically got an incumbent US president standing for re-election, all right? Now, if you go all the way back to Roosevelt, you will see that every time an incumbent president is standing for re-election, the US market goes up.
Yep.
No other reason. That's it, right? Don't complicate it. Secondly, we're at the top of the inflation interest cycle. Now, we may not be at the very top for Australia. It looks like we are at the top now for the US. We're at the top of that cycle. So if anything, we're looking at an easing bias, okay? And we've got an AI boom going on.
Yeah.
So they're your three key themes, and they are essentially what's driving markets. Now, if you go back to the technology boom of the late 1990s, which is where everything sort of changed from being very fundamentally driven to being basically internet driven, no one was caring. No one was worrying about the fundamentals of all these new listings. These new companies, Yahoo, Google, Amazon, all these companies, people were just jumping on board. And, so it's a sentiment-driven market. If you look at the millennium boom, what people were talking about, as I said, with Fortescue, fundamentally rubbish, absolute rubbish. But people were saying the price has gone up. They tell their mates the price goes up. When the shoe shine boy starts talking about stocks, and the modern incarnation of that is incantation is the taxi driver. When the taxi driver starts talking about stocks, they say that's time to get out. So price begets price, and you just get prices going up and up and up because it's theme driven. And that's the important thing. Is it fundamentally driven? Is it news driven? Is it might be circumstance driven? If you look at, say, the energy, we had a little bit of an energy boom when Russia invaded Ukraine, because that's putting energy under pressure. The old coal stock suddenly had a comeback, and that's sort of news related or circumstance related. 360 is an AI stock, and it's one of the very few stocks that you can get a hold of that's AI related. So people are buying it. So it's sexy. Fortescue was sexy. CBA, not sexy.
No.
CBA, long-term buy and hold income stock, not sexy, boring big bank. All right? But 360 is sexy. Fortescue was sexy, and these guys get in the news, right? And it's very much a sentiment-driven market. So you need to simply be aware of that. And anyone, if you're in the current market and we're in this sentiment-driven market with AI, and you start looking at fundamentals, what's going to happen is you're going to probably miss out. There's opportunities you're going to miss out. Now, we've got, as Elio knows, a range of newsletters. We've got 2 newsletters, and this is what I do. I say to people, that one works, that one doesn't work. Don't use that right now. We've got the Activist newsletter, and it has a fundamental filter. And then we look for rising trends of blue chip stocks that are fundamentally sound, right? Then we've got the blue chip report. It doesn't have a fundamental filter. It just uses the ASX 200 constituent stocks, the ASX 200 index constituent stocks, right, as its universe. And we just analyze the trends of those stocks. Well, 360, Life 360 is currently sitting at the top of that list. Yeah. It is the fastest rising ASX constituent stock available at the moment, right? So why? Well, because it's sexy, because it's AI. That's why. Not because it's got the best fundamentals, not because it's got the best price, the best profitability or all that sort of stuff. That's not why. It's just sexy. Is it on the Active Investing newsletter? No, because it's got a fundamental filter and 360 doesn't pass the fundamental search. So there you go.
But it's
if you're
definitely
using a fundamental filter, you'll miss out.
Yeah, and just a reminder too, if you're a guest of Alan's today, that we actually do provide the quality score in regards to in the blue chip report. So you can actually use that. We publish that once a month. So you can see those if you wish. And there's also a special offer there for friends of Alan's as well. But that's a good lead in because
and just quietly too, Elio, I did check 360. It's actually not bad.
No, it's not terrible.
It's not bad. It's pretty good. So,
by
the way,
2 things either happen. Either the price runs ahead of the fundamentals or the fundamentals run ahead of the price. Either way, the two come back together at some point.
Exactly. I think what you're going to have at the moment is when you're in a sentiment-driven market, that's when price runs ahead of the fundamentals. And when you have a boom market, and I think the US, not so much Australia, but the US is, they're sort of really starting to accelerate, you're going to head for a correction. And that correction will be where price comes back to meet those fundamentals.
Inevitably,
it
always does.
It's inevitable.
Yeah. Look, I do want to talk about another one of my holdings, and this is one that's been quality from when I started looking at the market, and it's been running like an ultra-marathon runner. It hasn't really stopped at all, but there are some good lessons to be had from it, I think, particularly me as a QM investor, and just to showcase, because I should have done that for 360.
Sorry, if I can just before we depart from 360, one thing I should mention, it's critical. If you own an income stock and the price drops, so if I own CBA shares, let's say I bought CBA shares, let's say I bought them back in the day. I bought them back in 91, 92 on the original listing. So I paid $6.50 per share, roughly, right? In real terms today, if I work out the inflation over that time, an average of 2.5% per annum, that's about $14.70 today in real terms. That's what my $6.50 is in real terms today.
Yeah.
If you actually take the dividend payment and you work it out as a percentage of that what you originally paid for the share, not what the dividend yield is today, you'll actually have a yield of about 31% per annum. I know this because we've recently worked it out. If you include the franking credits, it's 40% per annum. So I've got this nicely matured income-producing asset called CBA, which I bought back in the day. It's currently yielding 40% per annum based on what I purchased it for. Okay, what am I going to do if the share price goes down? Am I going to sell it? Yeah. No, you're not. You're going to buy more. You're going to buy more. Now, here's the lesson. When you're with 360, when the share price drops, you're going to get out. Wow. So when you're managing this, you must have a trailing stop loss. And that's a critical concept when it comes to, and that's why I say, is it income, is it growth? If it's income, share price drops, buy more. If your growth and it drops, time to get out. So you lock in the profit. So you need to be actively managing 360. And that's exactly what we do. We have a trailing stop loss on it, and that's what we provide. Okay. But that understanding of why, because we own it as a growth stock, not an income stock.
And that makes perfect sense. No, that's right. Just actually, now that I look at the chart again, I do want your view on it. When the share price pops, I mean, it's great for existing holders because obviously, you're getting some of that sweet fish, and this came on the back of an update that they provided, obviously showing strong subscriber growth, plus the whole AI, blah, blah, all of what you talked about. But then how should us as traders, as it were, think about this? When it does pop, because the natural instinct is it's too late, but not always.
Yeah, that's correct. So what basically happens is you've got the share prices actually was meandering a bit there. If you look at that chart, it was actually dropping. If you go back prior to the gap where it gapped up, so and you can look at the volume you've got there. So it's rising, but it's not rising that quick. It's kind of rising over time. So basically, what we see, if you can just spread that out again, Leo, the way you had it before,
the way I had it before, yep.
Yep.
Sorry,
no, you.
So daily interval, there we go.
Yeah, there you go, perfect. So basically, there's two things on that chart. So you see the gap up. Now we would have had that submitted to my Alan Hull TV show, and I would have said, "Oh, this is nice. There's been an announcement. I'll go into the ASX website, boom, boom, boom." Go on a whatever platform and find the news, and you find there's an announcement. Oh, it's popped up on the announcement. The market likes this. That's terrific. Do you buy it now? No, you don't. So you buy the rumor, sell the fact. Okay, the news is out. The market has been now factored into the market. What you have to do, and this is what we would have said, wait to see what it does now. Does it start to trend up now? So what you have to do is once that news has come out, right, then you need to wait to see. And you can see there quite clearly on the chart that it started to trend up. You can also see that the volume on that side of the chart is higher. Look at the volume increase. So there's more interest, it's more active. So it's the whole thing's just so, therefore, it is a rising trending stock. So someone had submitted it to me at the time it gapped up. I've said, okay, put it on the watch list, keep an eye on it. Let's see if this is real or it's just a bit of a flash in the pan. Then a month later, someone submits it. I go, yes, now it's trending up. Now we have increased volume, increased interest. Now you should buy this stock. Okay, so that's quite specific in practical terms how to handle it.
No, excellent, good work. And I've been champing at the bit for this one because it is one that, like I said, it's perennially overvalued, but it rates highly on a QM perspective. Whoops, daisy, I just didn't type in correctly. Fat finger problems there. There we go. Pro Medicus. Just quickly as a bit of an eye.
Yep.
It's up there in terms of quality. It's up there in terms of momentum, but you couldn't get a value perspective on this at all. It's probably the most expensive stock on the ASX. But I tell you what, if all my charts look like the one I'm just about to call up, I'd be a happy man. So, Alan, tell us a bit about the PME.
This is a great case. Okay, so Pro Medicus, you're right. It's been a great stock. It does have solid fundamental underpinnings. There's no question about that, but it's now sort of departed from those fundamentals. Okay, and this is a very instructive chart. The reason being is because, and this, by the way, is on our blue chip report. It's right up the top of the list, and it's also on the ActVest newsletter because it gets through the fundamental filter. So it's everywhere on our systems. And so that you're probably looking at 80% of our clients, whatever. But basically, it's exponential. Now, when you see a stock that is linear, that's in a rising channel, that tells us the fact that it's rising in a linear pattern tells us that it is usually fundamentally underpinned and it's tracking those fundamentals. Okay. Now, there's a great scientific explanation for that, and you haven't got a spare 3 hours, so I'm not going to give you that. But basically what you've got is a stock that started out with a good fundamental foundation. It's caught the attention and imagination of the investing public. And now there's another characteristic that's come in, and that is price is begetting price is begetting price. And the price then becomes exponential. And that's where exponential trends come from. Now, once you go exponential, there's two things. One, it's sentiment driven. It can be fundamentally and sentiment driven. The clock's ticking. This is not sustainable. You can look at a chart of, say, Woodside Energy. That is a very, very long-term channel, very, very long-term channel. Not so the case with this. It's starting to accelerate. It's lifting away from its fundamentals. If you are prepared to hold it, this is where its perspective is important. if you say, I want to hold this long term, I'm interested in this for the next 5 years, I'd say, well, hang on to it, knock yourself out. If you're in it for growth over the medium term, which by I mean 6 to 12 months, then you're going to have to put a stop loss on this because it's bending away from those fundamentals. And if it comes under pressure, it's going to fall back to those fundamentals, that fundamental base. And if you draw a line through that chart, you'll see that fundamental line, that trend line is quite a fair way back from that market because it's bending up, right? And that's because it's sentiment-driven, price is begetting price. All good, but you need to put a trailing stop loss on it, if it starts to come back down. That, in other words, that's where crashes occur. That's where corrections occur. If you've got a linear stock that's a long-term, fundamentally underpinned stock, it won't crash. It won't crash. You don't have a linear trend then have a crash. It's very, very rare. You have exponential trends, then a crash. So this is kind of this could end in tears. It could drop quite sharply. You would know cases like Cochlear or CSL, fantastic stocks. Don't want to disappoint the market, come out with some bad news. CSL had some news, an event of a particular drug, wham, down it came because it's been a long-term exponential trend. So simply through that awareness of that simple characteristic of chart behavior, you immediately look at this and say, yep, great stock. I'm riding this one, but I think I'll use a trailing stop loss because it's getting ahead of itself. And if it starts to drop, I might just take some profit, if nothing else. That for me, I always say that's code for selling half.
Well, although I've got to admit to you, Alan, they've been telling me Pro Medicus has been overvalued since it was like $9. Today, it's like 100 and something. And seriously, think less, make more money is probably an old adage I always live by, and that sort of rings true. But look, there've been easy charts. I mean, we've shown some easy ones where there hasn't been much to talk about. But now let's throw up some more challenging ones. And I want to start with Coles. COL, got to eat, right? And normally in a recession, and when things are tough, usually the consumer staples do okay because they're basically underlying that. But actually, it was one of them. Oh, sorry,
Sorry, can you
how tight do you want to bring it?
Compress that time frame? Just compress it.
Yeah, to 3 months or tighter.
No, go the other way. So bring it in. So
so that's 6 months.
Bring it in more. Bring it in more.
3 months.
No, they go the other way. I want like 2-3 years on the screen. Can you do that?
Sorry, you want 2-3 years, right? Okay, so there's 2 years. Yeah, so there's 2 years.
That'll do. Okay, for the point of the exercise, this chart is if you sent this in to me and you said, I'm a growth investor. I want to invest. What do you think of Coles, right? And you said it's starting to trend up. You can see in that last sort of 20% of the chart how it's starting to curve up. That bit there that Elio's highlighting. I would say I'd be a little bit worried about that because if you can you draw a horizontal line, Elio? Just put a horizontal line on the chart.
Sure can. Yep. I'm sure I'll do a thicker one so everyone sees it. Yeah. Whereabouts do you want me to draw the horizontal line?
That'll do. Perfect. Drop it there. Yeah, make it thicker if you can. I can barely see it. There you go. That'll do. Roughly enough. Okay. Now, this stock has been range bound for years. Okay. So it goes up to that level, then it pulls back. Then it goes up to that, pulls back. So if you, we right at the right-hand leading edge of that chart too, by the way, Elio. So what's going to happen is, let's leave it, that's fine. So what's going to happen is, as it's in this current trend and as it's trending up, that where it's reached that previous high level there, right, and it's done it repeatedly, okay, that's going to provide resistance to the market. So what's going to happen is that trend is going to rise up and it's going to hit that level and then people are going to sell it. Now, you're probably asking why. Behavioral, probably heard about, it was considered very sexy about a decade or so ago. It was called behavioral finance. And I always laughed whenever we heard about that because that's what technical analysis is. It is behavioral finance.
That's correct.
So basically, you right where Elio's got his cursor there. So no, not the black one. Sorry. So just move it back to where it, right in the middle of the chart where the price is hitting. Just there, that peak, right? So what's happened is you're an investor. Coles comes up to that level. You buy Coles, right? Now, from that point, the market has only ever dropped down. The price has gone down. So all you've ever known is loss, right? If we just ignore the dividends for the moment, right? All you've ever known from a price perspective is capital loss. So what are you going to do when the price gets back up to that level that you paid for it? Yeah. You're going to sell it. You're going to go, I'm going to get out of this with a 100% refund and happy days. And that's exactly what people do. So whenever we see a peak, whenever the market comes back up to that previous peak, we know that that previous peak is going to provide resistance to the market, okay, because there's people who purchased at that level who are looking for that 100% refund, okay? So that's exactly what's going to happen here. And the fact that it's reached that level sort of multiple times means that we know there's quite a lot of investors who bought at that level. So when the market comes up to there, you're going to run into trouble. So we would say you probably wouldn't want to buy it now, but buy it when it breaks through that level. So once it's tested that level and gone beyond that level, then you would buy into that trend if the trend can last past that level. Otherwise, it's probably too late to buy it at this stage. Now, that's evaluating it as a growth stock. Now it's evaluated as an income stock, and I would say that's absolutely fine, that chart. I wish all my income stocks did that, went sideways. So if Coles is sitting there, it's a toilet paper company. Let's talk qualitatively for a second. Okay, it's a toilet paper company. It sells toilet paper. Their business model is sell essential services, sell them at the lowest possible price, and make sure everybody knows about it. That's basically what they do. That's their business model. So they're a toilet paper company. They sell, what do they sell? They sell grog, they sell food, they sell toilet paper, they sell milk, they sell insurance. They think everyone drives cars and needs insurance. If it's an essential service, they sell it. So this is a classic toilet paper company, okay? It's never going to run out of customers. It's going along sideways. If it's got profit growth and it's increasing its dividend every year, but providing that share price is stable, I'm happy. I'm real happy. So, and then I also know as an long-term income investor, I'm probably not going to buy it now. I'm going to wait till it goes lower and I'm going to get a higher dividend yield, right? Yeah. So I'm going, okay, there's the range. Now, if you move that red line down, just move it vertically down, keep going to the bottom of the price range, that's around about where you want to buy it. So we use technical analysis there for the timing and say, I know when it's up and I know when it's down. I don't want to buy it now. It's too high. I want to buy it when it's lower because my time horizon is 10 or 20 years. I'm in no hurry, right? But I know that as an income stock, the fact that it's just tracking sideways, that's a linear stock. Beautiful, stable, fundamentally underpinned, perfect. Okay, so that's the assessment from an income perspective and a growth perspective.
So let's go to one. And a big shout out to you, Sagi, if you've joined us today thus far. But I spoke to you about Telstra this morning, a losing trade. And I admit that it was a losing trade. And I know that I'm no island because there's been a stack of you over the journey. But your interesting take on this, I think, is going to resonate with some people, Alan. So let's go to Telstra. Let me change that back to a 1-year chart right now. What's your view in regards to this business and where it's sitting at the moment? Yeah. And, I suppose all those learnings and how you're teaching your members at the moment looking at it.
Well, based on what I've just said about Coles, what do you immediately know about Telstra looking at that chart? You say, it's in a trend. This is where perspective is important. So if you look at it, over the last 2 months or something,
this is 1 year.
rising.
Yeah.
But look what it's headed for. It's headed for that line of consolidation. See, get your horizontal line again.
Yeah, coming.
Okay, just put it right through the guts of the price activity. Just
right through the guts.
Yeah, and just sort of lower it so it's in that sort of what we call a congestion field. Right there. Okay, what's going to happen to the price of Telstra when it gets to that level? It's going to hesitate because all those people who bought Telstra all at that levels, all they've ever known is a loss. It comes back up. You know what it's like. I'm not happy with the product. I want to take it back to the shop and get a 100% refund. That's what they do. That's what causes a double top. So the market comes up, goes down, retests the previous high, fails, drops away. You get a double top. That's where that pattern comes from. That's behavioral. It's all based on human behavior. So what happens is you now know, don't ever buy a stock when it's coming up to a previous consolidation. You want to wait for it to break through. That's growth analysis. Income analysis, a little bit more interesting. We could talk a bit to the history of Telstra, like, for instance, when they used to borrow money to pay dividends.
Yeah.
I think that had something to do with the government, who was the major shareholder, wanting to get their piece of the action. Yeah. So the company they borrowed money to pay a dividend. Now, we all know that dividends should be representative of profitability of the company. They completely fudged that relationship. Yeah. And I cynically, I believe they're under pressure by the government at the time to pay out as much dividend as they possibly could. So they actually borrowed money to do it. So I've got some serious issues, and have had for a long time, with Telstra from a fundamental point of view and a management point of view. I've also got a problem with it from a business model point of view. In a former life, I was a technical officer in electronics. So I'm basically a technologist. I understand all this stuff. And Telstra is a tech company. And that means, can I hold my hand over my heart and say, Telstra's going to be here in 25 years? That's probably my lifetime. I don't know, 25, 30 years. So is Telstra going to be around in 25 years in its current form? Is this a lifetime income producing asset? That's Warren Buffett's favorite holding time, forever. Is this going to be around forever? No, it's a tech stock. It's probably not going to be around in 5 years the way it is now. So do I want to buy this as a potential lifetime income producing asset? And the answer is, on a qualitative basis, based on its business model and its industry sector, the answer is no. Do I want to buy CBA? Yes. It's another sort of toilet paper company. It provides an essential service. It's a boring business model, been around for centuries. Do I want to buy Westfarmer? Yes. Do I want to buy ARB Corporation? Yeah, because when times are tough, people go four-wheel driving. So that's the thinking. Telstra is not, to me, suited to be a lifetime income producing asset. So unlike Coles that sells toilet paper, right? I'm not going to buy this stock I'm only going to buy it as a growth stock. It doesn't qualify as an income stock.
No, fair enough too. Now, just cognizant of time, so I do want to get through some questions, and I'm going to paraphrase here, Peter, if you don't mind, just in regards to your query, and try to keep it short, Eleanor, as best you can. But obviously, we are looking at portfolios here. I mean, anyone can pick stocks, but when it comes to managing money, that's a whole different kettle of fish. And the whole concept of money management, and, how many stocks you should hold, what sort of time frames, etc. I mean, if you're a swing trader, that sort of throws you in that 3 to 6 month sort of basis. But he doesn't want the normal crap we get, which is, diversify, hold 25 stocks, blah, 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 all that stuff, all that sort of thing. So what sort of advice could you give Peter in regards to portfolio construction that would, help him, particularly if he does have an eye to those technical analysis and the squiggly lines?
Yeah. Okay. So you've got to determine your perspective, and you've got to determine what works in the market. So there's those two things. And whatever we do in the market has to cross over both those things. So if I've got an income portfolio, for instance, in terms of the management technique of an income portfolio, I don't use stop losses in my income portfolio. So I don't have capital protection for my income portfolio. In fact, if the share price is dropping and the market's dropping, that's when Warren Buffett starts running around with his checkbook, when the markets drop. So I'm going to do the same thing. So I can't use stop losses. So I must have diversification. We absolutely need diversification as a form of risk management in our income portfolio. Now, there's those of us who've struck a HIH, and there's those that will strike a HIH. Okay. They simply lied to the market. They were, on paper, an excellent income-producing asset, and it's insurance. It's this lovely, intangible, very old, proven business model. So the only protection you had was diversification. That's that side of it. So if you're owning a portfolio, and we have an income portfolio, it contains 19 positions. So it's fairly diversified. If you own a growth portfolio, if you own a growth portfolio, then it's a different kettle of fish. We have a maximization, minimization problem, because if you over diversify, all you're simply going to do is end up owning the market. So if you've got 30 stocks in a growth portfolio, you're just going to match the index. Simple as that. Okay. So there's a kind of optimal level. I think it's somewhere between 10 and 20. I think once you go beyond 20 in the Australian market, which isn't, by the way, a very big ballpark, okay, you're going to be over. There's too many stocks in a growth portfolio. You need a greater concentration. So basically, I'm looking for the fastest rising stocks that are reasonable, green chip, blue chip, fundamentally sound, stocks, and I can fairly comfortably easily find 10 of those. Now, if I'm risking 2% per position, in other words, I'm using a trailing stop loss, and if that share stops out, right? If a share stops out, I'm going to lose 2% of my total capital. Does that make sense? So let's say, for argument's sake, I've got 10 stocks and I'm risking 20%, right, drawdown stop loss on each one of those stocks. Then that means that each stock I'm risking 2% of my total capital. Fair enough?
Yep.
Portfolio risk is the number of shares times the risk per share. So then you're looking at a maximum portfolio risk of 20%. Okay. Now, if you had 15 stocks, that's 30%. If you have 20 stocks at 2% risk per stock, that's whatever it is, 40%. That's, the less stocks, or there's a sort of happy medium where we don't want to be too concentrated, but we don't want to be too spread out. I personally put that at between 10 and 15 stocks for a growth portfolio. Okay. If you are actively managing and trading, in other words, it's literally a day-by-day proposition, and I certainly do that as well, then it's more a case of how many stocks can you really actively manage and keep an eye on. And that comes down to lifestyle. I've seen people, I've done it myself. Elliot, I'm sure you've done it, taken a $5,000 aeroplane trip. I jump on a plane here, Melbourne. I get off at Brisbane. I've lost $5,000 because I'm trading some penny stock that I probably should have sold before I jumped on the plane and I didn't have access to the market. So, or I've got 15 stocks in my penny portfolio, right? And I just simply can't stay across them all at the same time. So it depends on your lifestyle. It depends on your temperament. It depends on what you're trying to manage and achieve. Is it growth? Is it income? What's your time frame? And it depends on the market.
Yeah. So, and thanks very much for that, Peter. I'm also going to get to your question in a moment, Bryce, and we'll talk about that. But I do want to also just share with those of you who are guests today, just because I'm aware of time, those of you who are guests, that book that members can go and buy, that's at Alan's store, for guests, we'll actually give it to you free if you come on board as a Stockopedia member. So just subscribe to Stockopedia, become a member, receive our information, and we'll send you the book for free, provided, of course, you go past the 30-day money-back guarantee period, because we're not a charity, as it were. But nonetheless, though, and our commitment to education unwavering. So, Alan, Bryce did ask about some interesting stocks. We don't have the time to cover them all, but one I did want to actually cover was CSL, because this touches on some of the lessons that you've actually hang on, what have I done here? There we go, up the top. This touches on some of the lessons that you've shared with us to date in regards to CSL. Just to let you know, you're looking at a 10-year chart. I'll change that to a 5-year chart.
Sorry, go back to the 10-year chart.
We'll go back to the 10-year chart.
Okay,
right,
this is a beautiful example. Can you pull in more of the chart? Can you actually get more than that?
How far back can I go?
I want to see it. I want to see it up till now, but I want to see it. If you can even go, that's it. Beautiful. Perfect. No, that'll do. You don't have to go too far. Right. Okay. When a stock or a new company starts life on the stock market, no one's bought. Remember I told you before, there's people bought and the market drops, it comes back up, they provide resistance.
Yep.
If you own a stock where it's newly listed, and this is why when we have a newly listed stock and it starts to rise, no one's ever protecting their profit. No one's ever protecting a position. In other words, everyone in that market is in profit, aren't they?
Yeah.
There's no overhead resistance. So price begets price very easily. That mechanism works very easily. Now, if you look at CSL, and you'll see the same pattern if you look at BHP, Rio, CBA, ANZ, Westpac, any of the big blueies in Australia, you will see this pattern over years and years. It started out life pretty much flatlining, and it just went up in an exponential trend. Can you see that? For years, it's gone up in an exponential trend. That's it there. And then the music stopped. And it started going sideways in that linear channel. So you see how it's going sideways in that linear channel now? Okay, that's pretty much the end of the huge growth phase of CSL. It has now come of age, all right? So in that early bit, it's gone through a phase change. And that's why that chart's so important, because it shows you the two different phases of its life. Its initial phase, where we didn't fully know the potential, right? We didn't fully know the potential of CSL, and it's come up to a point where it's now matured, and it's now. In other words, it was more sentiment driven. It should have been technically traded. Now it's more fundamental. Now it's really fundamental. It's linear, right? So from a linear perspective, if someone said to me, "Oh, is that a growth proposition?" I'd say no, not at all. Is it potentially an income stock going forward? Yes, it is. But you can see there how it's changed personality. And this is what stocks do. This is what entire markets do. So you're going to have a market that's going along in a linear channel. Bang, all of a sudden it takes off. That's what the ASX or the All Ords did. If you go back and look at it from the 1990s, and it just suddenly took off in the millennium boom because of China. How big is China going to be? How much they need the commodities? How huge? It's going to be huge. How huge? Oh, huge. We don't know how big. So we don't know how big. So our stocks are just all going exponential. Rio's taken off. BHP's taken off. People are buying, rubbish at the time, Fortescue, all this sort of stuff. That's a sentiment-driven phase. That ended, and now we've gone and we've formed a huge long-term channel right back to the start, to the base of the GFC. And that's what you're seeing on that chart. You're seeing a chart that's gone through a phase change, and that is now potentially an income stock. As a growth stock, I'd say its days are finished. It's over. All right. So that's a beautiful example.
So, Dick, just in quick response to you, Alan's book is $29.95. So there's no further discounts or anything applied there, but seriously, a great investment. I feel you could probably claim it back on tax if you got a good accountant. But look, in regards to this, so this all we've talked about today, Alan, is alanhull.com, and that's your share investing, your trading perspective, and everything you look at that regard. But that's not the only thing you're known for, of course, because you touched on behavioral economics, you touched on the power of the mind, and how we all think when we're holding a stock and what we do. You branched out and you also added alanhullwellness.com, which is a division of the business, but it is about training your brain, and not just in regards to shares, it's in regards to every aspect of your daily life, isn't it?
It's not. I mean, we do it in relations to shares. So to give you the history, I've been involved in mental health for decades, mainly around drug and alcohol work. And we hit where it started. I mean, as people say to me, why do you do this stuff? If you're so successful, why are you still doing this stuff? I'm still doing it because I love it, right? And I get money's an enabler, and I have enough money to do whatever I want to do. And I wanted to start this wellness business after what happened in the COVID lockdown in Melbourne. And I saw, I know myself. I mean, I consider myself, I'm very healthy. I run a lot. I exercise a lot. I don't drink. I don't smoke. I've got a very good friendship group. I'm involved in a large fellowship. All that sort of stuff. I'm sort of really on song. And I was suffering during the lockdown under COVID. So it became apparent to me there was a real need around mental health and around wellness. And that's essentially that's what I started the whole business. If you look at the key aspect of it, if I said to you, and this is what happened, people were getting anxiety, people were getting depressed, people are, 60% increase in the consumption of alcohol, all these sorts of stuff was going on. It was really, really tough. And I'm just going to say, I found it tough. And I mean, what about people who are locked up in an apartment building by themselves for months? Really tough. But basically, if I say to you, I've got a headache, Elio, can you help me? You're not going to hand me a Band-Aid. All right.
No.
So you understand your body and you understand that physicality. We all do. People don't understand their brains. And there's two different parts to your brain. There's a thinking brain and a feeling brain. And it's all about that, because it's the feeling brain. It's that animal, lusting, habitual, childish part of our brain that, for instance, is addictive, right? And it suffers anxiety. Now, we'll take a simple example of a doctor who knows a huge amount about drugs, obviously knows all about that stuff. They're a drug addict or they're an alcoholic. And people go, they know so much. They right across. How could they be an alcoholic? That's crazy. I say it's because it's not their thinking brain that's addicted. It's their feeling brain that's addicted. Okay? And what we do, we teach our thinking brain, but we train our feeling brain, right? We train our feeling brain. And that's what people don't realize. We actually need training, right? Mm-hmm. So, I'm constantly training, and I'm learning. So the fact that you realize how your brain's made up and how it's structured, it's like you're not going to use the wrong solution. No one's going to hand me a Band-Aid if I say I've got a headache. And no one's going to say if I say I'm feeling anxiety, and they're saying, oh, you should go and read a book. That's not going to help you, because I know, I need strategies for dealing with the anxiety. I personally suffer morning anxiety. One of the ways that I deal with it is to wake up very fast, to get my thinking brain, because when my thinking brain's running the show, I don't feel anxiety. It's in the morning when I wake up with my emotions, and my feeling brain wakes up quicker than my thinking brain. So one of the first things I do is I turn on lights, sound, because they associate that with waking up, and I read a book. Because when I read a book, it wakes my mind up, it wakes up my brain, and the anxiety goes away. Another simple trick we often have when you go into a workplace, you'll see people on their desk have pictures of their children. So they're pictures of their 4 or 5-year-old, cute pictures of their kids on their desk. Get a picture of yourself when you were 3 or 4 or 5 and put that on your desk. Because what happens is when you see that picture of your children, it activates your protective parental instincts towards that child. So you sit there at work, you're not in, I'm working, I got to earn $1, and you look at the picture of the child, you say, this is fantastic. This is why I'm here. This is why I'm here, to put a roof over their head, to protect them, to educate them, to help them grow. Well, do that for yourself. Put a picture of you when you're 3 on that desk, and look at that picture and say, I am 100% responsible for this guy's growth. I'm 100% responsible for the opportunities that he's going to enjoy. I'm 100% responsible for his health and well-being. And it will change you. You probably heard the expression, it's a bit airy-fairy, called self-love. That's a practical way in wellness that we exercise self-love. Look at a picture of yourself and your children, okay? So in very practical terms, again, I'm a very practical person. So wellness is a very practical thing. I approached it from that perspective, and it's really about just mental health. And I'll just finish on this, Elio. It's proactive. We have to stay mentally healthy, and this is why it's such a tough thing, because people aren't inclined. If your arm's fallen off, you'll get it fixed. The problem is we start to get mental health issues, and people simply don't deal with it. Yeah. The principal way that we don't get mentally unhealthy, mentally ill, is we stay healthy. We've got to be very proactive in it. And that's exactly what I do. And that's exactly what I teach. AlanHullWellness.com. So we've got free weekly mind tips. You go to the website, you can click on that and get free tips. And thank you for the opportunity to let me talk about it, Elio. Thank you.
No, that's all right, because it's such an important part of trading, investing, call it what you will, is the power of being able to control your mind and your emotions and your feelings, and going beyond that and taking it into everyday life is, again, another skill trait that many of us investors don't appreciate when we're in the cut thrust of analyzing numbers. Yeah. But actually,
I can give you a simple, when it comes to the thinking brain versus the feeling brain, we have a saying, people trade their bank account, right? So they look at the trading platform and they see their shares going up and down, and it makes them feel good or feel bad, right? So if you look at Stockopedia platform and you look at what your shares are doing, what you're actually doing is switching on your thinking brain and you're analyzing what's going on, and you won't feel so bad. But then people look at their bank account and see that they've lost money. That's your survival instinct. That's part of your feeling brain. Don't trade your bank account. Don't look at your bank account. Look at Stockopedia. Look at the platform. Analyze what your shares are doing. Don't look at the money, right? Don't trade your bank account.
And you'll feel the better for it. But trust me, you can do that. It's no problem with us as well. But suffice to say, we help all faiths in this church we call investing. Alan, on behalf of all of us, thank you for investing your time with all our members this afternoon. I sincerely hope they found it of value. Of course, this is one component of our ongoing Mastermind Investing series. Another large amount of you as members, members also of the QAV podcast. Tony Kniston, well-to-do chap from Sydney. He'll be sharing his views in regards to investing and the like. He has a bit more of a quality and value bent, Alan. So we may be very well seeing you come along in order to just hear him chat about how he views the world. But again, thank you so much for so clearly articulating to all our members just how easy it can be, but also how challenging as well this investing game. Thank you.
Thank you.
Okay, and one other little disclaimer, folks, which I'll leave there, and we'll say goodbye right now, and we look forward to talking to you again in the not-too-distant future. So take care, folks. Bye now.